Good evening, everybody. Welcome back to Hurdle Rate. For this video, we're going to build a DCF model for American Express. We're going to start with our blank spreadsheet and try and get to a fair value estimate. So without further ado, let's get going. I just do a quick bit of commentary on the stock price recently. Earnings came out the other day. I think they came out yesterday, and they were very good. As you can see, the share price shot up by 7% on that news, and the share price is now trading at all-time highs. The last 5-year performance has been incredible. It's up 3.5x. So yeah, I mean, this is a company that I've always feel I've missed the boat on, similar to the way I feel about Costco, in that it always seems like, oh, this is always very, very high. And then you always miss that opportunity and it just keeps going up. But I think it's probably more fairly valued on a multiple, from a multiple perspective, than Costco. But nonetheless, it can be, let's have a look at profitability ratios. Yeah, 23 times earnings. That's cheaper than Visa and MasterCard. And forward PE, it's even lower. So yeah, let's start our DCF. First things first, obviously open your spreadsheet, go onto the SEC website, pull up American Express, and we need the latest 10Q, and that's near the top because it was released on the 17th of October. That's yesterday. And if we go down, we can find the 10K annual report. It's the 2nd of, no, this would be, yeah, 2nd of July 2025. Yeah, perfect. No, it's the 2nd, 7th of the, how do you guys do it? The the 7th of February 2025. Okay, so pull it up, go to page 97 on the 10K, where we're going to look at the consolidated statements of income. And let's do the same on the, well, where have I gone? Where is this taking me? Yeah, on the 25, let's just put it up to where we need to be. I think it's actually a bit further down. The consolidated. I could look at the contents, but I always get lost on that as well. So yeah, here we are. And we're going to do a free cash flow to equity, FCFE, rather than FCFF, free cash flow to the firm. So we're trying to forecast the cash flows that will be generated for the equity holders, not the equity and debt holders, which is what FCFF is. And the reason we're doing that is because on the income statement for American Express, the interest income is part of revenue. So it kind of distorts it a bit. Interest income is usually down here, whereas operating income, yeah, it should be down here, above the income tax provision, but it's not. So all we're going to look at is we're going to look at these revenues. We're going to factor this in to get our total revenues net of interest expense, and we need the net income. So let's get started. As always, we go page layout, remove your grid lines, go view, freeze the first column, insert another one, make the A smaller, and make B larger, and in A1, type in AXP. That's the ticker for American Express. I can zoom in a bit as well if that helps. Go data, stocks. Yeah, looks good. No, there we go. And it's this one, New York Stock Exchange, AXP. There we go. First, we go ticker here, date. Then we want to know the current price, implied price, and whether there's any upside or down. Let's fill in these with a color just to, there's no reason to do this, it's just more for aesthetic purposes. Copy this over. We need just one here. Yep. Fill, we're going for this blue. If you watched the Manchester United video, we put it in a red, but we'll go back to blue now. Go back to what we normally use. In this line, we go assumptions. And this one, oh, okay, let's put the ticker in first. So equals A1 dot parentheses ticker. There we go. And we go here, A1 dot price. No, sorry, open parentheses, price. The date today is 18th, 2025. And now assumption. So the first thing we go, and this is going to be quite big, the revenue build. So revenue segment, bold switches. And the first thing we're going to do is, so this is the more conventional revenue, the discount revenue, the net card fees, service fees, and other revenue, process revenue. We'll go into what those are in a second as we're building them out. But the interest income, because obviously American Express takes customer deposits, gives an interest rate, but it's also when people are not paying their full balance back on time, they're getting charged interest on that. So that's where interest income is coming from. And obviously the interest expense is for people who are holding cash with American Express. They're getting an interest on that. So whatever that is net is then added to our total non-interest revenues to get our total revenues net of interest expense. So we'll do it sort of in one go, but break it down. So let's go discount revenue, net card fees, service fees and other, and then processed revenue. Then we're going to have we actually have to forecast this out with switches, only because we think because it could vary. So the way we're going to do this, we go, okay, interest on loans, interest and dividends, deposits with banks and other. Can do it like that. Okay, we can let's put in another, and let's go non-interest revenues. If I just then we want interest income here, but we can, then we want interest expense then we want the long term, but call that LT debt and other. So okay. I mean, one thing we could do is we just forecast the net interest income, but it's better if we divide it. Then on the below this now, we want cost of equity, because we're not using the WACC, because we're not factoring in the debt holders. So we're just doing just for the equity holders. So, and then the terminal growth value, and then these down here. We need our switches. Actually, let's there we go. Okay, in here, just put it all equal to 2, because that's going to be our base. Then leave the bottom 2. Okay, revenue build. We're going to start in 2022. we take that, just keep add 1, and just put it all the way along up to M. We want to go to 2030. Do we? Yeah, we want to go to 2030. I just overshot it a bit there. There we go. Then come back. I can zoom in a bit more actually. Yeah, I'll come out of it. There we go. If need be, I can put it to, let's go to 135. Yeah, that's better. And is it, have I got it as B11? We start equals B11. Percent growth. And we want the bear, base, and bull case scenario. And we want to know what it is as a percentage of revenue. I know I always forget this bit, but yeah, it's good to have there. And the discount revenue these are the fees that Amex takes from its merchant. So when you pay with your Amex card, the discount revenue is what is charged to the merchant for accepting that payment. And that's quite clearly the highest driver of revenue for the company. So it starts in 2022, 30 billion 739. Just quickly format number. Do brackets for negative numbers. The ones in parentheses, use the comma to separate thousands. And this is done in millions. So 3739 million is 30.7 billion in revenue. 33416. 35192. And we want to work out what the growth rate is. So it's for this segment, yeah, about 8%. Just format it. The way we do the way to calculate that. Sorry if I went too quickly. It's we take the year that we're the later year divided by the previous year and subtract 1, and we get 9% here. And to get it, we just copy it across to find the next, and then we're obviously going to do this one. Yeah, let's work out what it is for 2025. Process revenue. Oh, yeah, they don't put that on this one. It looks like they've changed it. They've probably added it, merged it into the 3, but we'll see. Where is it? Okay, so for the 3 months ended, let's see if they have it for the 9 months ended, because I would rather do that than multiply it by 4. Here it is. Of course, yeah, there we are. So 26. So for the first 9 months, they did 26 billion and ended the year on 35 billion. So divided by 26,015. So 1.35. If we time that by 1.35, we should get a good ballpark figure for there we go. Yeah, so 6-ish%. It's in line with the growth. Now let's copy these down. Come down here. That's better. Now just format these before we do it, otherwise it will stretch the columns. Percentage, 2 decimal places. Perfect. So let's take an average of the last 3 years. So 6.6% growth. And we'll put that as down for next year. We'll say, I mean, it's usually quite robust, Amex, because of their clientele. They're usually fairly affluent, and they're sort of in an affluent, at that level of affluence where maybe they still have the income during both economic booms and busts. So they're not necessarily that, I guess maybe it's not as volatile as other companies who experience the booms and busts depending on how well the economy is doing. So let's say it trends towards 5%. 5%, and what's that? G11. So we're forecasting fairly stable growth, and I don't think we're being too bearish or we're not being too bullish, but yeah. Now we want to sort of just smooth out the revenue growth over the next few years here. So we want to go from 6.6 to 5 and just have it smoothed out. And the way we do that, we take the previous year, so the 2026, we subtract, open brackets, again the previous year, minus the final year, close brackets, divided by, open brackets, the last year minus the previous year. And we close all of that. And we want to now lock in certain parts of this so that when we just copy paste, it automatically just sort of adjusts rather than us having to keep changing it. But okay, so what do we want here? We want to lock in the column, but not the row. This one is permanently locked in. So you do a dollar sign in front of the column and a dollar sign in front of the row. Then this last one, just the row we want locked in. We want the columns to adjust. So yeah, there we go. And go Command or Control copy, whatever you're on, whether you're on, if you're on a Windows. Yeah, that looks good. And we're going to sort of do the bear case here and the bull case. Let's do, I mean, it's not going to be too far from what we're saying, so we'll keep it quite narrow for both the bull and the bear case. Remember to lock this in. And you can just copy it over like that. And we can do the same here. And you just, yeah, but this needs to be G36. There we go. Pull it across. Perfect. Now here, because we want to connect this to the switch now, so that when we toggle between 1, 2, and 3, we're going to get the different simulation for the growth rate. So we go equals, we use the offset function. The cell that we're in, we select that G34, comma, the switch, which is discount revenue, C11 here, and then lock both of these in because we're going to pull them across, then comma, then 0. Can you all see that? You got that? Perfect. Just format it, and you can just pull this across now. And to get the forecasted revenues, you take the previous year, multiply it, open brackets, 1 plus the growth rate. Let's see, if we just copy these down, what happens? And this needs to be B12. So, okay, come back onto the other sheet. So net card fees. This is what when you get your Amex, you pay your yearly fee, and that's what net card fees are. 60707255 8449. Then in 2020, so let's just do equals 8449 divided by 6204, 1.36 equals 7364 multiplied by 1.361863331. Okay. Oh, this growth is really good. So let's say it eventually settles at 15. G12. There we go. And you have to change this to 12. Pull it across. Same down here. Pull it across. And then we're just going to fix this now. There we go. And this one just needs to change to C12. pull that across. There we go. And if I'll show you how the switches work. Hey, you came. No. So look at these numbers here: 3960, 42140. Let's go on to the bearish case. It comes down. If we go bullish, it goes up. And we toggle on these, simulate different scenarios depending on how we think, performance will play out. Now, let's do the same for the next. We can just copy all of this down, change this equals B13, services and other revenue. Let's just have a quick look. So remember this number, 5129 plus 1636. So that's 67. So it should be about 67. What are they forecasting for this? 5246. Okay, well, let's put all of this. Yeah, okay. Let's put all of this in one, because that's what they've done on the latest. They haven't put processed revenue in. So let's service fees and other revenue plus processed revenue, and then that way we can work out what the 2025 is, because we don't have any idea for processed revenue. So you find this a lot, is every few years the company changes how it reports, because sometimes it has different products come out, it has different it just changes. You see it. I mean, you see it a lot with, I think, when we do Pepsi, for the last few years they've reported segments in a certain way, but now for the next one they're changing. So once we get the next annual report out, we will do a model on Pepsi, and you'll see 5129 plus 1636. Okay, now we do, let's work this out. 5046, 1.34, 5. $587. Okay. I mean, I think this year. Actually, no. I mean, it was 9%, 1%, 10%. So this is actually quite a volatile part of Amex's revenue. I think, and this comes from things like their concierge services, the travel part. So yeah, let's put it to 8. Actually, I think let's keep it at 10. So I think it's. I mean, they're continually building out. They are, yeah. So yeah, I think we can. Let's say G13. It does have a strong moat, Amex. It's got sort of that Costco feel to it, where when they have a customer, it's as if they never leave, and it's almost, I guess, quite. It's you feel quite exclusive. It's like joining a club, isn't it? That's what it wants to give up, I guess. Let's delete this row 14. And now we go into the next. What's the next? So we're going to look at this interest income and interest expense. So our revenue bill is actually going to be very. It's going to be huge in terms of space taken up on the spreadsheet. I'm going to do something a bit different here, because this is a bit unorthodox revenue. Let's put this into a light blue. And what I want to do is we do, what are we calling it? just call it interest income. Just call it. Yeah, you just. There's no. I mean, it doesn't have to be done like this, but I just want it clear because it's not the orthodox revenue stream for interest on loans. Because I mean, it operates a bit like a bank to Amex because it does give out loans, and it does say it pays interest on cash and it gives out loans. So it does actually take on a bit of a risk there because when say people are paying on the credit card, it's Amex lending to them, and there's always the default risk. But I think the Amex customer is probably they're seen as a low default risk because they're again, as we said earlier, they're seen as fairly affluent. So okay, interest on loans. Come on to the other page. 1196. If you haven't hit subscribe, please do. 697 21095. Okay, equals divided by multiplied by 1.3529374. There we go. Okay. I mean, this is huge. This so the revenue they're making from interest on their loans, it's like 20 billion a year in revenue. That's a lot. The growth, let's say, yeah, but I think that could, let's go 5% and it's G16. By all means, guys, when you're doing this, fill in your own numbers. If you know, if you have more insight into the company, if you've looked at it a bit more and you think actually you know what, you're wrong there, this revenue stream is going to grow significantly faster, by all means put your own numbers in and simulate it that way. This is I mean, at the moment a lot of this is guesswork really. It's very hard to predict, and you've got to keep updating it every time there's a new earning so you can get more and more insight into the company, and then you can be like, oh, okay, this is good, this is bad. Equals B17. Interest and dividends. Have I got this right? 16, 16, 16, 16, 16, 16. Yeah. Okay, what was this one? 17. Let's just work out what the interest on dividends and okay, this is very small, a very small part of the business. That's 96 million 128 86. Then 46 do 86 divided by 68, 1.2647. So go 40 multiplied by 1.26470,588. Interest on dividend. I mean, where will it go to? I think it maybe just goes to 0. It stays around this number. Okay, we'll put it as, let's go 2%, or maybe let's keep it at 5, 95%. Actually, I'm going to put that to 0. This one really doesn't matter because it's such a small part of the revenue. It's not going to move the dial at all. But what we want to see from this is the the bull case is it's lower, and the bear case is it's, sorry, the bull case is, have I got that right? Yeah, I have. So I've just got to update it on here. There we go. Because when it's negative, the bull case has to be, say, 95% of the negative number, and the bear case is, say, 105% of it. So yeah, that's what we'll say for now. I think there's not too much point going into that much detail on that one. So revenue build, what was the 17 wasn't, so we're on B18 now, deposits with other banks. Okay. There we go. Okay, so 595, 2158, 2614. Let's look at the previous year. 2058. Is that right? Yeah. So you equals 1800 multiplied by 1.270165. That's okay. I mean, it's not going. Let's just say it grows 5%. What should we say this goes to? I think leave it at 5%. Equals G18. Okay, yeah, looks good. Next one, onto the interest expense. If you want, we can. If you'd like to total, let's total up the revenue here. Just for clarity. Just put one more line down. No. Then delete this one. There we go. Okay. And call this total non. Here we go, sum. Because when we're doing our totals, we can just take it from this. We pull this along. There we go. If you want, we can put another. Let's work out the growth. Just pull it from here. Pull it along. There we go. Yeah, perfect. Now we can do, yeah, let's do another subtotal here. Total interest income. And this equals sum. Yeah, it's only 3, isn't it? Yeah. Pull it along. Perfect. Now we want to look at, what did we want to look at? We want to look at the interest expense. So these are outgoing, so we're going to put them in brackets because when we sum it all, it will, rather than going total non-interest revenues plus total interest income minus total interest expense, we'll go just sum it all, but we'll put it in brackets so it will get subtracted. I forgot what number we're on. Deposits. There we go. And if you want, we can have a title up here. Okay, interest. Why is that there? Deposits. Deposits, B21. Let's remember that number when we're doing it. Now, remember, we're going to put this in brackets. Go on to the other page. Deposits, so 1527. 1527. 1527. Yeah, okay. You could put negative and then it will automatically, because we formatted it, it's automatically going to go into brackets. 4865 minus 5695. Deposit. So we take the previous year, 5695 divided by negative 4298. Negative 4082 multiplied by 1.3250349. There we go. I mean, let's say they stay stable-ish. Let's just go 2%. No. There we go, and we'll just leave it at 2%. Is it 21? There we go. Yeah, good. Change all of these. Pull it along. Oh, we haven't done all of this, the switches. Silly me. $18. Did I do that right? Oh, I forgot all of these. I hope you guys didn't, if you're following at home, that you 16. Yeah, looks good. $21. Yeah, okay, let's. There we go. We're almost done now on the revenue build. Just this last segment to complete. Long-term debt and other. And remember, we keep them in parentheses because they are outgoings rather than incomings. And it is confusing that it's put as where the revenue, we're used to seeing this much further down the statement. We're usually used to seeing it down here, just above net income. But obviously, because the interest part is such a crucial part of core revenue for Amex, I guess it does make sense that it goes there. Minus 1984. But do leave tell me in the comments if you have invested in Amex and what were your reasons for doing so. So I wish I'd owned shares of them. They've if you'd held them for the last 5-10 years, you'd have done very, very well. 2257 divided by 1915. Yes, good. 2092 multiplied by 1.17859, but make sure you put a negative there. Yeah, that's good. And again, yeah, we'll leave this at 2%. There's not much. Unless we want to. Yeah, we'll do it. That's fine. I think it's. This needs to be 22, doesn't it? There we go. Yeah. Well, why is this not G22? Great. Now we can let's get our let's do a subtotal. We'll do it like that. We should do that the same for they're subtotals rather than okay, so total interest expense is sorry. There we go. Pull it across. Now let's do net interest income. And this equals sum of these two. Yeah, I think that's right. No, equals sum. What are you doing? Oh, I know why, because I didn't put a comma. There we go. Yep. And we can check if we have that right here. $9,985,1314,15,543. Oh, where have we gone wrong? Where have I gone wrong? Did 22575695 23795, so that's okay. Whoa. Yeah, here it is. 22557 it should be. There we long-term debt 2024. Sorry, negative 2557. There we go. That's better. Okay, but this looks like it's becoming, if we don't have a higher interest rate here, then this is accelerating, I think, a bit too fast. So let's go 5, 5. Would that be better? And for this one, we'll just do the average of the last, because this 219% I think seems a bit outrageous, but we'll do the same for the 29 and -4. I think, yeah, I think that's better. Okay, now we can do total revenue. Put a hard line. Looking good. Bold it. Go sum. We want net interest income plus total non-interest revenues. 5268862. That's what we get there. Perfect. Pull it all across. Let's see if this is growing or not. Yeah. Okay, that looks good. Okay, yeah. Let's go on to the next. Nope, not that one. So for what seems like a very simple company, it's quite a complex revenue build. But because we're doing FCFE, free cash flow to equity, we only need the revenue and the net income now, rather than the EBIT and the taxes and all of that. So this should be relatively straightforward. It doesn't need to be bold. Just pull it across. And I don't know if we do more, because I guess a lot of you, I mean, put in the reasons why you're buying, why you've bought Amazon, if you're considering buying. Is it for growth or is it for the dividend? Because I mean, the yield at the moment is quite low because the price is so high, but it does increase. We'll look at it in a second, but it does increase its dividend quite quite a lot. So you get very good dividend growth. 7514. 8374. 10129. And let's look at the growth. It's not the growth we want. We want it as a percentage of revenue. Sorry. Do it to there. I think we can do it here, the simulating. We don't have to do it on the actual DCF. If you want, actually, yeah, let's just do that. Let's just go straight into the DCF and we'll build it this way. And that will take us 1 second. Yeah, we'll do it all in one rather than having the DCF section like we normally. We need it for FCFF, but for this one, we can just do it. We can cheat a bit. Net income, what was it for down here? So if we go 7959, 1.27, 8371, 1.27264732. No, we want to do our, so it's about a 15% net income. And let's say it keeps that, its revenue is going to continue to grow. Oh, I've missed one. Okay. So net income, we'll put it to 2, and we'll say again, yes, copy all of these, but we'll call this 15%. What's that? G24. Yeah. And we'll say it maintains this 15% or around that over the next 5 years, because it's been very consistent in the previous years. We'll probably say it won't grow because obviously there are competitors to Amex now. There's the Chase, I think it's the Chase Reserve Card, Chase Sapphire, that are going after the Amex market. There's other upstarts going after, I guess, the younger crowd, like, what was it? What would it be? Revolut, I think, has its own points and rewards program. So, but Amex is probably the only one that, say, genuinely has the scale on it, because 24, what did I put up here? Equals C24, 15%. Oh yeah, because I no. Let's get equals offset. Am I going mad? G120, sorry. C24. Yeah, looks good. Are we happy with that? Yeah. So yeah, as we were saying, there are. I mean, Amex is the one that can probably scale at the most because it does its own program in house, whereas I think Revolut and the other ones probably are partnering with other companies to do that. So their margin probably can't be as good as Amex is, especially as they're going to be spending a ton on one on the customer acquisition, but also their margin is eating because they have a third partner that does theirs, whereas Amex does theirs in house. So yeah, okay, it looks good. Let's go to the cash flow items. Give me 1 second. Okay, cash flow items. This is on the cash flow statement, which is on page 41 for the 10Q, and on, here we go, page 100 for the other one. So we need this one, depreciation and amortization. This is our change in net working capital. We then need our where is it? This one, purchases of premises and equipment for CapEx. Then down here, this is debt raised. So net increase in customer deposits, net increase in short-term borrowings, proceeds from long-term debt. That's debt raised. Then debt paid is payments of long-term debt. So yeah, let's go. Cash flow items. Let's go DNA. This one, I mean, it shouldn't take too long. And the cost of equity, I think, is fairly, when I say it now, I think it's fairly straightforward, but we'll have a look. We'll probably just use a global equity risk premium for that, but let's focus on that a bit later. Let's now focus on the cash flow statement. So 1626. I mean, it looks fairly consistent year on year. 1651, 1676. Let's see what this is as a percentage of the revenue. The reason why everything is done as, I guess, a percentage of revenue is that your revenue is always, I guess it always has to be positive. I mean, ignore say like free revenue companies, etc. But it has to be positive, and then your operations can be negative, your net income can be negative, but the revenue has to be. So I guess it's always a good one to do a percentage of to get a gauge. One, 2, 4, 8. Yeah, that looks good. Go average, pull it along. Just go revenue multiplied by I think we just do, so this is capex now, and that is, where did we say it was? Purchases of premises and equipment, net of sales. So 1855, 1563, 1911. One 1855, 1563. Have I done all of them? 1911. Yeah, that's next one. $1911 divided by 1416, 1.34 equals 1703 multiplied by 1.34957,627. Come back. Whoa. We do not want that much capex. Okay, and now your change in net working capital is this changes in operating assets and liabilities, net of effects of acquisitions and dispositions, etc. Normally, if you follow it on the other ones, it's usually a longer line. It's got your accounts receivable, accounts payable, the changes in there. But this one is, it's a bit smaller. So let's, it's better. And I think it might actually be quite good for Amex. You want this number to be negative, because then it increases your free cash flow. It means you're getting paid before you're delivering your service. So not so much for 2022, but certainly for the other one. Oh, this is huge. Whoa. 20% of revenue equals negative 1244 plus 5065 equals 1007 minus 2897. Then this year, for now we'll just leave it as as it is shown here, minus 1330 plus, sorry, minus 1333 plus 3324. And we just average this out. Let's copy it from here. We take it from revenue. Yeah. The last bit is we want to factor in the debt raised and the debt paid, because we add the debt raised to the free cash flow and we subtract the debt paid from the free cash flow, because obviously they're having to pay their interest payments and pay back whatever debt they've raised. And this one, so we're going to sum these three. Equals 25,902 minus 706 plus 23230. Whoa, it's loads, 48 billion. Wow. Equals 18,915 minus 105 plus 15,674 equals 10,305 plus 207 plus 12,602. Loads of free cash flow because of this debt, taking it on. Okay, so let's just sum up 2024. 6305 plus 169 plus 12,519. Then we do 23, so 1.21. So we take sum of these up, multiply it by 1.216. Multiplied by 1.21697,467. Oh, that's a lot of debt they're taking on last year. Because the reason we have to say on the we're counting the customer deposits, because when those customers deposit their cash, they are getting an interest rate on it. I don't know what the interest. I forgot to check what the interest rate is before doing the video, but it's not. They are having Amex is having to pay them that, and they are the lenders. So sorry, they are the ones paying the interest. It's coming from them, not a third party. So yeah, that's why we have to treat it as debt raised. Then we go debt paid. Let me know in the comments if you are following along, and I guess if you've made it this far, you're doing your own spreadsheet. But yeah, let me know. It'd be interesting to see if who's doing the full build, and if they're finding it useful. If you are finding it useful, I appreciate you watching. And if there's anything that you want me to cover, whether it's certain parts of if you want to discuss, say, depreciation and amortization, we can do a video on there where we focus solely on that. Or if we want to look at, I did a video on the balance sheet of Uber the other week, and that's quite interesting. We're looking at the liquidity and the solvency. If you want more of those, do let me know. Tell me what you want, and I'll see if I can do those for you. 10,759, 7,358. Yes. That's a huge amount of debt paid. Is that right? Yeah, it's massive. Okay. I guess if they take on a lot of debt, they're going to have a higher debt payment. Remind me, well, actually, I'll remind myself, on the when we do the beta on the cost of equity, we need to use a levered beta. Cash flow items. Okay, well, let's just put another row section here, and we'll call it the DCF. And we're going to now calculate the levered free cash flow. And we do that by, we take our net income and we add back in the depreciation and amortization because it is a non-cash expense, and we subtract the, sorry, we're doing it in the wrong bit. We don't need it for previously, we're just forecasting out. So let's start again. Levered free cash flow is we take the net income, we add back depreciation and amortization because it's a non-cash expense. We subtract the capex, we subtract change in net working capital, we add back the debt raised, and we subtract the debt paid. Although, can I just check that this looks, because if this is all the debt paid, why is this so low? Because it needs to be the revenue multiplied by there, pull it all across. That's better. There we go. Silly me. Now do the same here, just pull it all across. Before we can go any further, we want to find out the present value of the levered free cash flow. So we now have to build out the cost of equity. And your cost of equity is, let's very quickly just take off our grid lines. We go cost of equity. Oh no. Cost of equity is, here we go, cost of equity equals your risk-free rate multiplied by your beta multiplied by your equity risk premium. No, sorry, no, I got that wrong. I'm not concentrating. Start again. Cost of equity is your risk-free rate plus your beta multiplied by your equity risk premium. I hope those that have watched a few of these and you'll have noticed that mistake and you'll have called me out and be going, oh, what are you talking about there? And you're doing right too. So let's go cost of equity risk-free rate beta ERP. Let's be neat. So this one is easy. I mean, as you've seen, we've built it out nicely before, but I think for today, let's just blast through it. So 4.011%. We're going to use it. American Express is obviously an American company, therefore we'll use, and it generates its, or well, it reports its revenues and earnings in USD. So we will use the US 10-year as a risk-free rate, and that's 4.011%. 4.1011. And then the beta and the ERP. Let's do the ERP now, because what do I want to? So the country premium. So a weighted average is 5.88%. And let's just have a quick look at the weights. Where's North America? 28.94%. The way I'm going to look at this is that I'm going to say 60. Let's go 65% of its revenues are from the US. We'll say 20% from Europe, Middle East, and Africa. 10 to 15. What would we put? So what's this? So that's 85. Let's go 15 on this one. Then we'll go 15% for Asia Pacific. Oh, actually, just like we'll do Asia in general. And then we'll go LATAM. We'll say 5%. Would this add up? Yeah, that gives us 100. So North America, EMEA, APAC, LATAM. Okay, so we can say the North America is okay, 4.58. EMEA 6.22. APAC, small Asia. We'll go 5. We'll do Asia in general. So it won't be APAC. It will be what do you call it? Asia. I'll fix that. 5.92%. LATAM 9.51%. And this is, I mean, it's very difficult to multiply it by here. No, sorry, I did that wrong. Okay, let me just copy this onto the other sheet so that we've got it there. Bring it down here. There we go. Okay. So this is your weight. This is your ERP. And we want the weighted ERP equals then we just sum it together. 5.27% equals duh. Now let's do the beta. Industry. I think it's just going to be financial services, to be honest. Financial services and retail. We want, what do we want from this? So we want the unlevered beta. We want the unlevered beta. We want the revenues. Yeah, you can all see. I'll pull this up a bit. We want EV to sales. We want the value. What do we want after the value? We want the weight, the proportion, then the weighted beta, then we want to lever the beta, levered beta. Okay. Let me pull up my beta spreadsheets. It's not mine, it's Professor Damodaran's. You can download these on his website at www.damodaran.com. And he's got all his data there. I'm on the wrong one. Total beta. This is what I want. So let's take all of these off, and financial services. Do we want banking in there? No, I don't think so. Financial services, and well, let's pull up retail and we'll have a look when we go back to the revenues. But yeah, okay. So we want this 0.27 and 1.04. 0.27, 1.04. And the revenues, so I mean, I think service fees and other, no, net card fees and services fees, I think we can put into retail. We'll put that as retail general. Or would you put it into, is there a tourism or hospitality? No, there isn't really a recreation or restaurant dining. No, I think yeah, we'll put it into retail general. Um, but all of this, the banking side does need to be in. So the net interest income will be financial services, as will probably discount revenue because it's the facilitation of transactions. But net card fees and services and others, I think we can put as retail general. Mm, no, we'll do net card fees as well as being financial services. We okay, come back over here. Equals. Oh no, not now. We want to say sum. No, we can't. We'll just do it like this then. Where's our net interest income? We do this one plus why aren't you working? There we go. And for this one, we just want the service fees and other. Almost done, almost done. I know this has been quite long. EV to sales, where did I put it? 19.3 and 2.05. Wow. 19.3, 2.05. It's huge. No, it can't be. It's not valued at more than $1 trillion, is it? That's ridiculous. I think we take the interest income stays there, as does 1 second. 48, 41. Let's take this one off. And we add it down here. I mean, it's obviously not a year. It's now sum these up. Just lock this one in. Oh, no, it needs... There we go. Now the weighted beta is, you go proportion multiplied by the unlevered beta, then sum. Now we want to find our levered beta. And can we all remember how to calculate it? So your unlevered beta equals your levered beta divided by 1 plus 1 minus your tax rate multiplied by your debt divided by equity. So where do we find all of these at? Well, first of all, we need to rearrange. So we say levered beta equals unlevered beta multiplied by 1 plus 1 minus the tax rate times by your debt divided by your equity. So we can find all of that on okay, so here's the balance sheet. The equity is 32 billion and the debt is about 58. Yeah, that's about right. And the tax rate, I read it earlier, it's like 21.5%. So we'll use that. But it's somewhere down here. I can't remember where. But yeah, let's just do that. Let's go with what did I say it was? It was about 21.5, I think. Income taxes. Here we are. Yeah. 21.8. Wait. The effective tax rate was 24.1%. But let's do this one, 21.8% for the 9 months. And then let's come back up to the balance sheet. Here we are. Yep, okay, looking good. So our levered beta is going to equal the unlevered beta multiplied by 1 plus 1 minus, what did we say it was? 21.8%. Actually, what I'll do, so we go unlev beta is equals 0.3, tax rate equals 21.8%. I'm going to be fuming. It's not going to come out as one, but if it just comes out like really close, like, why do you bother sometimes trying to work all of this out? And then equity. So our debt is 1446 plus 57787. The equity is 32417. So our levered beta is going to equal unlevered beta multiplied by 1 plus 1 minus, close bracket, multiplied by the debt divided by the equity. 1.7, 1.72, wow. Seems a bit high. Okay, so our cost of equity, almost done, guys, almost done. So risk-free rate plus the beta multiplied by the equity risk premium. Wow, 13.1%. It's because the EV to sales for financial services is really high. I mean, I don't think. I mean, I would have this like in less, to be honest, maybe 8-9%, 2.5% for the terminal growth value. Let's do so for the bear, we add 0.5%. Oh no, no. Sorry, it's getting late. Uh, for the terminal growth rate, we just add 0.5%. We minus 0.5% here. For this bit, so for this, it's like the offset. We just go equals choose, and we select each one here, but make sure we do it in order. We go. Let's just have a quick look again at this, because basically what's happened is American Express is being treated as a fintech, basically. So it's having a fintech valuation, which is not really right, because actually, I mean, because it is a mature company, it shouldn't have this. This should be closer to 10. But also as well, the debt is significantly higher than the. That doesn't necessarily matter, the debt being higher than the equity, but yeah, that's why it's so high. But so anyway, that's what we've got, and let's discount those back to the present value. So PV of levered free cash flow. And on top of this one, I always forget to put these in, but it's important. We go 1 plus 1, then just pull this over. Then we go, you take the levered free cash flow divided by, come back up, open brackets, 1 plus your cost of equity, but lock in, and then go to the power. There we are. And just pull all of this along. Perfect. Now, levered free cash flow, present value of levered free cash flow. What do we want now? We want the terminal value. And that is, you take your final year multiplied by 1 plus your cost of equity divided by your cost of equity minus your terminal growth value. And this is what we're getting. We had to get maybe like a 500 odd billion terminal value. We want the present value of your terminal value. And that is, you take the terminal value divided by 1 plus your cost of equity to the power of the final year. Yeah. Equity value is then, you just take your sum of your present value of terminal value and your present value of free cash flows. You just sum all those up and you get 404 billion. Diluted shares outstanding. What's the other one? Implied share price. Almost done, guys, almost done. Here we are. Diluted shares outstanding, 698 million. And then to get the implied share price, you just go equity value divided by the diluted shares outstanding, and you get a target price of 579. So what's that? K154? Yeah. So this is, I mean, let's come back to base, but potentially there's a 66% upside here. Let's see what a worst case scenario is. 512. It looks quite good. For these two, though, deposit, switch this around. So this should be 105. Because if it's higher, it's probably worse. Not necessarily, but let's go that way. Let's go with that. Looks good. Great. Yeah, looks good. So potentially there's some good upside on this. We'll have to keep monitoring it. Trying to see have we been too aggressive? I don't think we've been too aggressive on anywhere. We're reasonable net income, which we know they can achieve. Yeah, okay, I'm happy with that. Cool. Okay. Well, thanks for watching, and yeah, I'll see you guys on the next one. Bye. Remember, hit subscribe. Thank you. Bye.